The Relative Strength Index, or RSI, is everywhere. One of the first tools new traders learn. It's a momentum oscillator moving between 0 and 100, with overbought above 70 and oversold below 30. Sounds easy. Buy when oversold, sell when overbought. But if it were that simple, everyone would be rich. The problem? Most traders use RSI as a direct buy-sell signal, ignoring market context. In strong trends, RSI can stay overbought or oversold for weeks. Selling just because RSI is above 70 or buying below 30 often means fighting the trend and losing. RSI isn't a crystal ball. It's a tool that needs interpretation. Instead of treating RSI as a signal generator, use it to gauge momentum. Is buying or selling pressure increasing or fading? The real mistake is ignoring the trend and treating RSI levels as automatic triggers. To use RSI effectively, you need to understand the bigger picture, market structure, momentum, and context. The standard overbought, oversold approach is misleading. There's much more to RSI than meets the eye. Let's break down how to unlock its real power. Most platforms default to a 14-period RSI, but this isn't a magic number, it's just tradition. Markets change, and a one-size-fits-all setting like 14 often lags behind real price action. By the time RSI 14 signals overbought or oversold, the move is usually half over. You end up chasing trades or missing opportunities entirely, especially in fast-ranging markets. Relying on the default setting filters out good trades and gives a false sense of security. The market demands precision, not passivity. To make RSI work, you must adjust its settings to fit your trading style, time frame, and asset. Don't let the default hold you back. Customization is key. Next, let's see how to avoid the most common RSI mistakes. The biggest mistake? Blindly buying below 30 or selling above 70. Overbought doesn't mean a crash is coming, and oversold doesn't guarantee a rally. In strong trends, these levels show strength or weakness, not reversal. Another error, using RSI alone. Without price action, support resistance, or volume, RSI signals are unreliable. Context matters. A signal at a key level in a trend is far more powerful than one in the middle of nowhere. Many traders also ignore RSI divergence, which can warn of momentum shifts before price turns. Finally, using the same RSI settings for every market and condition is a recipe for failure. Adapt your RSI to the asset and environment for better results. Let's see how to customize RSI for faster, more accurate signals. To make RSI more responsive, shorten the look-back period. Try RSI 5 instead of 14. RSI 5 reacts quickly, giving earlier signals and helping you catch moves near turning points. But it's noisier, so adjust the overbought, oversold levels. Set overbought to 90, oversold to 10. Here's how. Add RSI to your chart, set the period to 5, and change the bands to 90 and 10. Now, RSI 5 only signals extremes when momentum is truly stretched. When RSI 5 goes above 90, it signals a potential short-term top. Below 10, a possible bottom. This isn't about buying every dip or selling every spike. It's about spotting when price has moved too far, too fast. Use these signals for mean reversion trades, short after extreme buying, buy after extreme selling. This method helps you catch short-term swings with better timing. But remember, don't use RSI 5 in isolation. The real edge comes from combining it with market structure. Let's see how that works. A fast RSI is powerful, but only when combined with market structure. Always look for confluence, confirmation from trend, support, resistance, or price action. In an uptrend, wait for a pullback and RSI 5 to dip below 10. That's your high probability buy. In a downtrend, wait for a rally and RSI 5 to spike above 90. That's your short setup. The RSI signal is your trigger, not your reason. Ignore RSI 5, sell signals in uptrends and buy signals in downtrends. Trade with the trend, not against it. This approach filters out low-quality trades and keeps you aligned with momentum. For example, in an uptrend, only buy when RSI 5 is oversold during a pullback. In a downtrend, only short when RSI 5 is overbought during a rally. By syncing RSI with market structure, you dramatically improve your odds. No more fighting the trend or chasing false signals. Use RSI as confirmation, not a standalone system. Now let's talk about risk management. Even the best strategy needs risk management. Place your stop loss just beyond the recent swing below the pullback low for longs, above the rally high for shorts. Set profit targets at previous swing highs, lows, or use a risk-to-reward ratio. Aim for at least twice your risk. Never over-leverage. Risk only 1 to 2% of your account per trade. Proper position sizing protects you from emotional mistakes and keeps you in the game. To sum up, ditch the default RSI, customize it for speed, and always trade in context with the trend. Use RSI 5 with 90-10 levels for sharper signals, but only as confirmation within market structure. Combine this with disciplined risk management, and you'll turn RSI from a frustration into a powerful trading tool. Trade smart, stay flexible, and let the market come to you. That's how you trade with confidence.